At 9:30 a.m., a central banker steps up to a microphone. By 9:31, trillions of dollars move. Not because of a law, not because of force, but because markets believe. Now imagine the moment they don't. That's the uncomfortable truth most people miss. Central banks don't actually control money. They manage expectations, and belief is fragile. This matters right now because we're living through a rare period where that belief is being tested. Inflation surged after decades of calm. Interest rates jumped faster than anyone expected, and markets started asking a dangerous question. Do they really have this under control? To understand what happens next, you have to understand how central banks really work. They don't set prices in the economy. They don't tell investors what to do. They send signals. A rate hike says we're serious. A pause says we're cautious. A press conference says everything between the lines. Markets listen, interpret, and then decide whether to cooperate. When belief holds, the system looks stable. Investors accept lower risk. Inflation expectations stay anchored. Borrowing costs behave. But when belief cracks, the math turns ugly. If markets think inflation will be 2%, they price bonds one way. If they think it'll be 5%, they demand higher returns immediately. That pushes interest rates up without permission. Here's the irony. Central banks can raise rates, but markets can raise them faster. We've seen this movie before. In the 1970s, inflation ran ahead of central bank credibility. In the UK in 2022, bond markets revolted so hard the government reversed policy in weeks. In emerging markets, loss of confidence can collapse a currency overnight. Publicly, the story is always calm. Tools are sufficient. Policy is data-driven. Inflation is transitory or persistent or moderating. Privately, the reality is harsher. Once markets stop believing, every promise costs more to make. Every intervention has diminishing returns, and every mistake compounds. The hidden mechanism is incentives. Markets know central banks hate recessions. They know politicians hate unemployment, and they know pain has limits, so they test those limits. Push yields higher, sell the currency, force the hand. Long-term, this changes everything. More volatility, less room for error, higher costs of debt, in a system that depends less on authority and more on credibility earned day by day. Because in the end, central banking isn't about power, it's about trust. And once trust becomes negotiable, the real question isn't whether markets will believe again, it's how much they'll charge for it.